Hello everyone, there's a stock that I've recently added over £1,000 to in my stocks and shares ISA I hold on Trading 212. I have a portfolio of over £47,000 that I hold in just 9 individual companies that tend to have excellent free cash flow growth and monopolistic market positioning. Today I'll be discussing the position I've been adding to, why this company fell over 15% the day after its earnings report, and why I think the current fundamentals are very attractive relative to the price that it's currently trading at. As normal, if you guys get something out of this video, then please feel free to consider giving it a like and maybe consider subscribing to the channel. So to kick it off, this is my Trading 212 stocks and shares ISA account with an overall value of £47,725 or so. So I just hold this amount in concentrated individual positions. We can see I focus a lot on monopolistic companies that are first in their fields or business segments. Amazon obviously being my main position, first in cloud and e-commerce in the US. Visa being my number 2 position, number 1 in card payment processing company in the world, and etc. But there is one company in particular that I added to quite recently, just before the weekend, on a day of particular weakness. Now, Mercado Libre, or MELI, is a position I added to. They released earnings just after market close on Thursday, and the market responded quite poorly, with the company trading around about 15 to 16% down on the Friday. That was from highs around $2,100 down to around $1,700, $1,800. And I'm going to dive into the earnings report shortly to explain why I think this is a bit of a mistake by investors. But first, I want to discuss my buy, how much I devoted to it, and the reasons why. So I already had a position of around 2.3 shares of MELI at a cost basis around $1,600 or so. And then I added around £1,034 to bring this position to a very round number, adding around 0.7 shares, bringing my overall position to around 3 shares in MELI, valued at around about £4,300 or so. And it's up by about 10% in unrealised gains, or nearly £400 at the moment. And that brings MELI as part of my invested portfolio to just over 9%, which is a considerable position and shows I have quite a bit of conviction in this particular company. So to cover why this company saw such a drop in share price, it's worth knowing what the expectations were going into earnings. Well, they expected around about $5.27 billion in revenue, which they beat by around 30 million. And around about 35% revenue growth year over year, which is what I would call premium revenue growth above 20% and is very hard to do for companies year over year. And then we've got an EPS estimate of around about $9.85, which was a miss of around $2, getting around $7.83, which was around about a 20% miss, which is no small thing, and we're going to dive into the reasons why. So this metric alone was enough to send the stock down, but there was other things in the earnings report that maybe people have concerns around, particularly around free cash flow. But analysts tend to focus on EPS because its earnings per share is something that shareholders can attribute to them, and if it's going down or up, they can see that their earnings on the shares that they do own is getting higher or lower. So it tends to be a default position for investors to react to negative EPS numbers. But if we dive into the earnings report and the shareholder letter that MELI produce every time they release earnings, we get a bit more context as to why this less earnings per share than expected has actually come about. So items sold grew by 28% year over year. Their revenue grew by 35% to $5.3 billion. Income from operations sat at around $557 million at a 10.5% margin, which was down quite a bit from their normal margin around 20%. in Q3 of 2023. And net income was 397 million, a 7.5% margin compared to last year's margin, which sat closer to over 9%. And then we've got finally adjusted free cash flow at 203 million, down 127%, which is obviously looking quite a bit of a drop year over year. So we've got a few things there. We've got worsening margins on the net income and on the income from operations year over year, and we've also got the adjusted free cash flow obviously showing quite a bit of a negative drop year over year. So I think those things is what has driven this particular stock down. And if we take a look at these margins in particular, we can see maybe the ramifications of how they've been reduced down. So we can see the margins got reduced down to smaller from 9.1% net income margins last year to 7.5% this year in Q3 2024. And they have a few breakdowns of the reasons why. But to me, there was effectively two reasons for this lower earnings per share, free cash flow, and this margin expansion. It can explain all of those things. The first of which was improvements and investments into their logistics and infrastructure. So they have actually said this and cited it, and they've not hidden away from these margins reduction. They've actually talked about them non-stop. So they say our logistics network is a powerful tool to drive offline retail online, providing a better user experience for both buyers and sellers. So they have continued to expand their logistics and infrastructure to increase in penetration of fulfillment in Brazil and to keep up with strong pace of growth in their e-commerce operations in Mexico. So they've now said they've opened 5 fulfillment centres in Brazil in Q3 2024, plus another one in Mexico, which, although this could cause and has caused short-term pressure on their particular margins, they think it's critical for long-term growth, scale and cost dilution. And additionally, they've also invested in their shipping network, which has had a knock-on effect on their overall cost to impact. So to me, it seems like they are building out their logistics to the detriment of their earnings and profits in the short term. They're not really focused on this short-term EPS growth numbers because they're still trying to grow as quickly as possible. This reminds me a bit of Amazon's focus and mindset. They tend to forego the profitability and popularity with shareholders on Wall Street because they hold themselves to build and grow with scale. I personally see this as a shareholder as very good. They are reinvesting into themselves and becoming the name everyone goes to in Brazil and Mexico and other countries, just like Amazon is the place to go in the US and European countries. Very similar to creating this network of customer satisfaction, the next day deliveries, the easiness with which you can use the browser, all these things create this user experience that makes it so easy and effortless for people to want to use them. And they just go to them first to buy whatever they've got on their mind or whatever they need. As we can see with MELI here, their investor presentation shows us their unique buyers has grown by about 21% year over year to almost 61 million. That's the fastest growth since COVID. So the e-commerce side of the business to me is producing 35% year over year revenue growth. It's sacrificed a bit of that EPS growth by 20% this year over year, but has also grown their unique buyers by 21% year over year to almost 61 million. So I'm seeing it grow in all the right areas. The things they're saying make sense. They're not just pulled out of the ether to try and explain this earnings per share drop. It's quite documented and evident from this margin breakdown that they offer in their presentation. And then we have their fintech business, Mercado Libre, which is growing around 77% year over year, reaching 6 billion which is their fastest growing rate since Q1 of 2022. So they've effectively said this has a negative impact upon margins because they've grown so quickly. They're focused on lower risk users with lower spreads, but their credit card part of the business of Mercado Libre has actually increased around 172% in growth. So this has contributed massively to the biggest margin decline of this year over year by about 3.4 basis points. So we've seen that basically they've grown rapidly, and that growth has come from the credit card part of Mercado Pago as well as other things. So they're growing really fast in other areas of the business, but the 172% growth in their credit card business has just blown it way out of the water. And that basically means that their credit part of the business has effectively had a knock-on effect, and now their earnings per share is suffering because of this reason. So the business has explained this short-term loss in profitability, and to me it just seems like a combination of a growing at a massive rate in Mercado Pago on the fintech side of the business, and working to improve the customer experience, logistics and infrastructure of the e-commerce side of the business. Both, I believe, are actually very good things, and that's mainly for the future as a long-term shareholder. Profitability will be massively helped by these two things in the future, but right now, this earnings report that everyone's focusing on and talking about, we see short-term EPS weakness and free cash flow. But what does that all mean? Does it mean that it's trading at an attractive valuation right now? Well, historically, it's trading at one of its highest historical free cash flow yields at around 6.5%, and that's considerably higher than the US Treasury free risk rate of around 4.5%. Now, the average for the past of this company in a free cash flow yield has been a lot lower. It's closely sat around about 2.5%. So to me, that signals a bit of undervaluation according to its historical free cash flow. And then we have their operating cash flow as well, which is a similar story, offering around a free operating cash flow yield of about 7.2% and historically trading closer to about 3.1% over the last 10 years. So we can see over that 10-year period, this is one of the best free cash flow and operating cash flow yields we've seen from MELI. Taking this further, and if we look at how this is being priced into their free cash flow growth over the next 5 years, so we can see currently the market is pricing in around about 10.5% growth to free cash flow over the next 5 years, as they currently sit at a price to free cash flow of about 15 times. Now, to me, that price to free cash flow ratio is quite low for MELI. Obviously, as we can see, historically has been much higher. And we could argue that an 18 times price to free cash flow is actually a better ratio in my opinion, but still on the conservative side for MELI. And then with the same sort of rate of growth around 10%, we get a fair value of around $2,100 and a CAGR over the next 5 years of around 13%, which is obviously a market-beating return. And if they can grow their free cash flow about a 10% CAGR, which I still think is very conservative, considering their growth rate CAGR for free cash flow over the past 5 years has sat at about 86%. Personally, I could see this being much higher than just the 10% easily over the next 5 years. So if you ask me, we've got an attractive valuation. It's at a reduced ratio for price to free cash flow than what is normal historically, and I think it's slightly unfair towards MELI. But the earnings report has had an impact on the market and what people think of MELI. So I saw this as a great opportunity to add to my shares, and I would prefer my allocation for MELI to remain below 10% because of the nature of international stocks, Latin American markets, and that sort of thing. So this is still one of the only stocks out of my companies in this portfolio that have reported earnings and actually gone down. So the buy has left me with just over £1,000 in cash on the sidelines to play with. But I'm very happy to own more of MELI. And we will see if this one grows like it is supposed to into the future. But thanks for watching, guys. I do appreciate it. And I'll catch you in the next one.